You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Ladies and gentlemen, please welcome to the stage Jeremy Johnson of BATS.
Thank you all. Again, please come on and sit down. Make yourself at home. Welcome to Texas. Welcome to Austin. Welcome to the OIC 2014. Happy to have you all here, 400 plus of our closest friends and competitors for a great week, great session, a few days of networking, a lot of great content to get to. I won't hold you up, I won't delay. We're going to get through the exchanges first, give everybody an opportunity to give you their updates, share the latest everything that's going on. We'll go one after the other, knock them out pretty quick. First up from BATS, Bryan, please.
Thanks, Jeremy. And thanks for everyone's time in the OIC committee for the invitation to speak today. As you all know, it's an exciting time to work for the exchanges. If we're lucky, somebody may write a book about us. So seriously, though, I'd like to take some time to talk about the BATS and Direct Edge merger. Really kind of explain to you why we're merging. And I think the simple answer to that is in our tagline, to make markets better. We're bringing together talented people and industry-leading technology to build a great company. 2014 is about planning for the integration, which includes making ourselves available to help you plan for the integration and have us walk you through the details. We currently run 4 U.S. cash exchanges, 1 U.S. options exchange, BATS MIAX Europe, and a European trade reporting facility. With our experience and breadth of knowledge, we're truly building a global company. BATS options market is part of the growing maker-taker segment, which accounts to about 30% today. We've seen our own market share grow from under 3% to just over 4.25% year to date in April. What makes us great is not only our technology, but the way we treat our customers by bringing value to the market. We focused on the retail segment to become the #1 retail limit exchange, and we've also created new products and services, such as the retail-only attribution and retail price improvement book. We're lowering connectivity costs for the market by consolidating our data centers, which also includes a cap on fees. Market data is an area of everyone's business that we can use some relief, and BATS continues to lower costs. With our combined markets, we've created value with our data. And with this data, we plan on providing multiple low-cost products. Plus, we also have a connectivity network called Connect Edge, where we're providing access to the Aubree data feed at a fraction of the cost. As an exchange operator, we continue to look for ways to move markets forward. Obvious error is an important part of our business that we've been focused on as an industry, and BATS has taken the lead to help drive this change. Jeremy Johnson and the industry has spent countless hours together, and I think everyone can agree that we need greater uniformity and transparency to help build confidence in our markets going forward. Risk management is also an area where we've been looking to improve upon. We most recently launched our improved opening process, and we continue to listen to our members to build functionality at the exchange level to help mitigate risk. With pricing, we continue to be aggressive and move forward. In May, we plan to support our first cross-asset pricing tier. This is an example of leveraging BATS global markets size and maximizing the value for the street. We understand that value goes beyond pricing. It's how you build a business and treat your members. At BATS, we appreciate the opportunity to compete and earn your business every day. It's an honor to be part of BAT's first OIC lead sponsorship, and I look forward to a great conference and catching up with everyone this week. Thank you for your time. And next, I'd like to introduce Patty Schuler from the box.
Thanks, Bryan. I would like to take a few moments to update you on what BOX has accomplished over the past year and what we are working on going forward. Since our last OIC meeting, we launched our complex order book in May of last year while rolling out additional functionality to support the complex order book offering. BOX's complex order book is differentiated from the other exchanges with our continuous implied functionality, allowing orders to imply out the leg price and interact with the regular book. We also have NBBO filtering mechanism for strategy orders to ensure that the order is not executed outside the prices of the strategy NBBO. In September, we launched complex order exposure functionality, giving participants the ability to expose their complex orders to the BOX market in order to solicit additional liquidity. In January, we launched our complex order price improvement mechanism, or COPIP, which permits complex orders to be submitted to the price improvement auction. All of the complex order functionality has been noticed by our participants, and we continue to see them connect to the offering, in addition to seeing an increase in volume and usage since we first launched the offering. From a technology standpoint, we filed and were approved in midsummer last year to reduce the NBBO exposure period to certain unexecuted orders from 1 second to 100 milliseconds. Early in 2013, we undertook an initiative to upgrade our hardware and network infrastructure on the BOX Sola trading platform. This was a months-long process to ensure a smooth transition without any issues. The upgrades were launched successfully in November. We also, during the same period, decommissioned several old protocol versions associated with the Sola trading services in November. This was a huge effort on the part of our participants to recertify over a 6-month time period. This effort was completed on time, no less. I cannot thank our participants enough for their diligence in getting this done, as well as our market operations team for their support. We are currently working on making available in our high-speed data vendor feed a more granular timestamp, the ability to show public customer interest, as well as upgrading our market data servers. And our market data is free, by the way. We are also making upgrades to our surveillance and reporting environment without any increase in ORF. On the regulatory side, in response to SEC, the exchanges, along with BOX, have been working on their collective plans to strengthen the resilience, performance, disaster recovery capability, and governance of the critical infrastructure of the U.S. markets. As part of this focus on enhancing market protection, BOX amended its rules in February of this year to clarify the automatic quote cancellation mechanism for market makers, the bulk cancellation and price protection for limit order mechanisms, which are available to all participants as well. BOX is in discussion with the other options exchanges to collaborate on a filing to make the penny pilot program permanent industry-wide. We also reduced the market maker quoting obligation to 1 contract based on feedback from our market making community. I just want to share with you a few relevant stats. In the month of March, price improved contracts on BOX represented an almost 300% increase over the previous month, with average daily savings of $479,000, and total savings to investors for the month was $10 million. A major milestone that I would also like to note is that in the next week or so, BOX will have crossed the $500 million threshold in price improvement savings going directly to our customers. Thanks again for your support. On a side note, we are working on the OIC conference for 2015 as the lead exchange. We are confident you will like the venue and the plans to add more engaging content. With Tony's input, we should at least be able to hit the mark on engaging content. We look forward to continuing the successful partnership with OIC and the other exchanges in offering another great industry event. With that, I'd like to introduce David Gray from CBOE and C2.
Thank you, Patty. And on behalf of CBOE, I'm honored and very pleased to join all of my industry colleagues here today. I'm looking forward to a great conference, and certainly this year there are many challenges facing the industry, and this conference, I think, provides an excellent forum for all of us to discuss them. From the CBOE's vantage point, we face these challenges by remaining committed to our core values, value propositions of serving as a market center for liquidity and equity derivatives and futures. Additionally, CBOE continues to innovate through proprietary product development, technology innovation, investor education, all of which I'll touch on briefly today. Along with the OIC, we continue to be focused on educating customers about options in general, but we're of course keenly focused on our proprietary product lines also. We're pleased that trading in our SPX complex continues to post strong growth. Volume in our entire SPX family of products was up 18% in 2013, and in the first quarter rose another 8% over the previous year. As weekly options have experienced an explosion in trading industry-wide, so too have SPX weeklies. Volume was up nearly 100% last year. Following several years of double-digit increases, and has continued to up this year, up 59% year to date. We've seen a new and significant base of retail and semi-pro customers become active in SPX weeklies, and this group's usage is continuing to grow. In addition, we're intensifying our SPX marketing and education initiatives aimed at a number of groups where we see potential growth, including SPY option users, but also including pension funds, asset managers, insurance companies, and who are just beginning to trade SPX, and particularly with a focus on overseas or global investors who can use SPX weeklies to hedge global economic risk or to efficiently take a position in the US marketplace. Turning next to the CBOE Volatility Index, considered the world's barometer for equity market volatility, trading in VIX options continues to reach record levels. Last year, volume rose 28%, and through the first quarter of this year is up another 22%. We're pleased that even in periods of low volatility, our VIX user base continues to expand as different customer types learn about volatility trading. The most exciting thing is that we believe we're still in the early stages of growing VIX, both domestically and globally. To that end, we're broadening trading access to our futures and options products. We began with VIX futures last year, and we extended its trading days by 5 hours and 45 minutes. Our goal was to respond to both US customers who wanted additional trading time and European customers and clients who wanted access to VIX futures during their local trading hours. Apologize, I have to read slowly because as I get older, the font gets bigger and bigger on the pages. On June 22nd, we'll expand our extended trading hours initiative for VIX futures to nearly 24 hours, 5 days a week. Of course, that's pending regulatory review. Once this expansion for VIX futures is complete, we'll look to offer our customers expanded trading hours for both SPX and VIX options later in 2014. New product development. We're also committed to providing our customers new trading opportunities through our ongoing commitment to product development. Not only are we looking to add new products to our VIX complex, but we're looking to bring volatility trading to new asset classes. Earlier this year, we launched options and futures on our new short-term volatility index. These short-term VIX products leverage the most compelling features of SPX weeklies and VIX products, including weekly expirations that enable traders to fine-tune the timing of their volatility trades. we've embarked on a major educational effort to help market participants understand the behavior of VXST, that's the short-term VIX, relative to VIX and other related instruments. Also in the pipeline for 2014, our products on the CBOE-CBOT 10-year U.S. Treasury Note Volatility Index, the first volatility index based on U.S. government debt. We began disseminating index values last May, and again, pending regulatory approval, we'll launch VXTYN products later this year. Like short-term volatility trading, we view interest rate volatility as an interesting, exciting new frontier in the volatility space. Enhanced investor education. Education continues to be an ongoing focus for CBOE as we aim to provide customers with a full spectrum of options and volatility resources. We have plans later this year to roll out a new educational app for mobile and tablet users and to unveil a newly redesigned CBOE website. While we are busy responding to a growing online and mobile world, many investors from around the world still wish to visit CBOE in person to see options and volatility trading firsthand and to attend our world-renowned CBOE Options Institute. To meet this demand, we recently completed construction of a new state-of-the-art facility for the Options Institute, and of course we invite everyone to view that for yourselves. Another component in our educational effort is the CBOE's Risk Management Conference, which this year marks its 30th anniversary. We continue to educate and be educated by some of the most expert and engaged SPX and VIX customers at this conference. This year's event drew near record attendance, and we're now looking forward to hosting our 3rd annual CBOE RMC Europe this September in Dublin, Ireland. 2 other noteworthy topics before I wrap up. In March, we announced our planned investment in TradeLegs, the developer of advanced software that investors can use to help optimize their investment performance. TradeLegs software allows users to input their view on a given security or portfolio of securities and receive numerous combinations of options and underlying positions that correspond to users' specific trading view and risk parameters. We think this makes TradeLegs a valuable trading resource for market participants who want an uncomplicated way to formulate options-based strategies that enhance their options positions, their equity positions too. I think you'll find TradeLegs a very appealing application, and if you'd like to see how it works, please stop by our booth during the conference to get a quick demo. Finally, a few comments about C2. In the maker-taker classes, which comprise all penny pilot ETFs and ETNs, we continue to maintain about a 4 to 5% market share. In our spread-based pricing for equity options classes, we recently amended our fee schedule to set all market maker transaction fees to a flat rate. This adjustment provides a level of certainty for liquidity providers while retaining a spread-based rebate formula that enables the customer taker orders to potentially receive rebates as high as 60 cents. We believe that in this space, C2 in particular provides a competitive alternative that could be attractive to specific customers and liquidity providers. Stay tuned for additional C2 enhancements throughout 2014. To wrap up, we're energized about the future as we continue to expand and promote usage of our products and benchmarks, as we welcome new types of users to our marketplace, and as we enhance our efforts to educate option users in new ways. Thank you very much for your time. It's my pleasure to introduce from ISE Gemini, Geralyn Endo.
Thanks, David. Best exchange customer service, best risk management initiative, best options trading venue. Sounds like a triple threat to me. ISE has received these awards along with several others over the past few years. But in my 10 years with ISE, I could not be prouder to be part of a firm that continues to provide tremendous value to its customers. Now, I know y'all need evidence that you actually learned something at OIC, so I'll give y'all, not bad for a New Yorker, right? I'll give y'all a moment to get your pens and paper ready because I'm about to discuss a few things that ISE has been working on to add value to you and your firms, including ISE Gemini, new functionality with a focus on risk management and precise, and new products. Launched last August, ISE Gemini was the fastest exchange to surpass 2% market share. ISE Gemini market share is now at 3% for products listed on the exchange. ISE Gemini offers maker-taker pricing combined with ISE's patented pro rata customer priority market structure. Combined, ISE and ISE Gemini market share is at 17%. We continue to increase the number of products listed on both exchanges to offer you more destination choices. For example, ISE recently listed over 300 new products, along with 3 new PMMs as a result of our alternative PMM program. This program allows CMMs to become PMMs in products for which there is no PMM interest. In terms of functionality, ISE, along with the rest of the industry, has been focused on risk management. In February, we introduced the market-wide speed bump, which allows ISE and ISE Gemini market makers to better manage risk within each market. In May, pending SEC approval, the market-wide speed bump will also be available across both exchanges. Market makers will be able to establish a common risk parameter across both ISE and ISE Gemini. This demonstrates our ongoing commitment to protecting market integrity and resilience for our exchange members. ISE continues to provide the industry-leading complex order book. To maintain your confidence in our order book, we focused on a number of risk protections in the complex world, including do not trade through, vertical price protections, and underlying price contingency orders, which prevent multi-leg orders from trading unless the underlying is within specified boundaries. While providing a suite of risk protections, we've also been focused on improving your fill rates. Over 26 million contracts have now traded as a result of implied orders. This functionality continues to enhance your complex order book experience by sourcing additional liquidity. We've also enhanced Precise, ISE's front-end application, to include order management functionality. In honor of this new functionality, we've introduced a new logo. Precise now supports parent-child orders, precise-to-precise routing, and done-away functionality, which allows users to manage orders and trades regardless of execution method or destination. Stop by the booth for a demo. Now, everything's bigger and spicier in Texas, right? Okay, I was going to have to do a sound check and make sure you guys were listening. So ISE has introduced something big and spicy that you can really sink your teeth into. We've introduced an alternative volatility gauge developed by industry expert Scott Nations, Valdex, symbol VOLI. Valdex measures implied volatility by focusing on at-the-money SPY options. ISE and ISE Gemini are the first options exchanges to enter a licensing agreement with Nation Shares. We are eager to have Valdex listed across all exchanges later this year. Check your room drop tonight for some more information. So without your awareness, understanding, and use of ISE's features, ISE would not have been named Best Options Trading Venue by Wall Street Letter. So I encourage you to come and talk to any of us. We can discuss the impact of implied orders on your order flow, risk protections, Precise, or perhaps you've been considering becoming an ISE Gemini member. Now's the time to explore each of these features. Thank you. And I now introduce Shelly Brown from MIAX.
Good afternoon. Thank you, Geralyn. Thank you, BATS, for hosting this wonderful venue this year. And thank you to all of you for coming today. So, a few things to talk about MIAX. Since we last spoke a year ago at OIC, we had been in existence for 5 months at that time. We were trading options on about 200 equities and just about to roll out our next 400 symbols. We were under 1% market share. Well, some things have changed and some things haven't changed. The things that haven't changed, we've been up now for 16 months, had 100% uptime since launch, 0 trade breaks due to system problems, and our speed is still the same. Very fast quote throughput for our market makers, median and mean quote round trip times from the edge of our system in to the edge of the system out with those quotes in the trade engine, about 25 microseconds. We've been able to maintain that speed while we've added 600 additional symbols. We're over 1,100 symbols. Symbols we trade represent approximately 96% of the total non-index option volume in the industry. And we're very proud of those results and very proud of the technical systems our team has put together. In March, we introduced what we call our select symbol rebate. There are 5 symbols that we now pay 20-cent rebates on for all priority customer orders. Those symbols are Apple, EEM, Facebook, IWM, and QQQ, some of the top symbols in the industry. It gives you an opportunity, no matter what level of order flow you have, to capture rebates on those symbols. The system capacity has been increased. When we were here last year, we were about 20 to 24 million messages a second. We can now handle 27 million messages a second, still at the same speed. We've added new functionality since last year, some of it for protection, some of it for true trade functionality. Auto cancel and disconnect was introduced last month. For any of you that are interested in that feature, testing is available. It was turned on 2 weeks ago. The protection functions we have at MIAX, we talked last year about our single tick protection. When you send a customer order or any order into MIAX, it's protected at 1 tick through the MBBO, no matter how far through that order is. If the order does not fully trade at the MBBO, get routed away, trade 1 tick through, we'll give the order back to you. Some of our firms have said we need more flexibility. We're introducing what we call multi-tick. That was approved by the SEC last month. It'll be rolled out over the next 2 weeks. It'll allow you as an EEM member of MIAX to designate on an order-by-order basis how many ticks protection you want for your order. So we will not run through the market unless you want us to. And we look at protecting the customer at all times. That is available in our current fixed specification 19A, which is on our website. Next thing we're rolling out is what we're calling MIAX Prime. That's the MIAX price improvement mechanism. That was approved by the SEC 2 weeks ago. Development is done. The fixed spec, again, is available on our website. It will be available on our website this week. It'll be version 1.10. Testing will be available next week, and rollout is expected in early June. We're also looking at our complex order mechanism. Last year when I was here, we told you we'd be doing complex orders this year. We still do plan on doing complex orders. Complex orders got pushed out behind our price improvement mechanism. Complex orders will be available late this year. Risk protection. Again, we're very, very cognizant of the industry efforts to protect the customers. That risk protection is in the DNA of MIAX. From the day we launched, we had pre-trade risk protections in place and trade price protections in place. We're adding additional risk protections. We're adding what we call our risk protection mechanism. It's a kill switch effectively for EEMs. It'll allow all of our members the ultimate flexibility in protecting their order flow. You will be able to designate for each EEM member, they can select any combination of MPIDs, how many contracts they're willing to accept trade, how many orders they want to have entered into the system. We will monitor your orders on a real-time basis. We'll monitor your trades on a real-time basis. If you hit any of your triggers, we will reject any new orders, or if you so choose, reject orders and cancel all open day orders. As an EEM, you can establish as many different groups as you want. You can have all your MPIDs together. You can isolate individual sets of MPIDs. As part of this program, we're also offering that same protection to clearing firms and other members. So if you're a clearing firm and you clear X number of members at MIAX, you can establish risk measurements across all the MPIDs for all the members you clear. Establish maximum number of contracts traded and or maximum number of orders coming through the door. We will protect you at the clearing level. You can have multiple sets of protections, whether you're an EEM or a clearing member. You can have a burst protection, X number of contracts over Y number of seconds. You can have a longer term protection, higher number of contracts over long time periods or the entire day. In addition to that, for any members who use give-up agreements with other members at MIAX, we allow those members to establish the same types of protections across all their MPIDs, across all their members. It's a unique protection. It allows you as a firm who has multiple give-up agreements to protect your orders coming through all the EEMs on the exchange. And again, the same functionality is available. You can have multiple sets of MPIDs, multiple sets of parameters for orders and or quotes, and you can choose to reject new orders or cancel all open orders. We also have new protections coming for our market makers group. Our ARM protection, our automated risk mechanism. For market makers, we'll take your quotes out of the market in any class once you've hit a predetermined percentage of contracts traded relative to your quote size. We're expanding that ARM protection 3 ways. We have a mechanism in place to prevent a race condition for inbound quotes coming in the door while you get protected. Some firms have automated that reentry. You can establish a maximum number of reentries, which would then require manual reentry into the marketplace. Pick up the phone to the trade desk. We'll allow you to establish protection across multiple classes. If you get ARM protection in X number of classes, we'll pull all your quotes across the entire exchange. You can also designate, if I get armed in a particular class or set of classes, we'll pull your quotes in another set of classes. You get in SPY, you get out of all the other ETFs if that's what you so choose. Again, it's all about protecting the marketplace and the integrity of the marketplace. We really appreciate the support of the industry. Again, we've been around now for 18 months. or 16 months. We've gone from under 1% market share a year ago to averaging just over 3% of the equity and ETF options. We greatly appreciate the support, and thank you. I'd like to introduce Aubree Greenspun from NASDAQ OMX.
Good afternoon. Thank you, Shelly. Welcome. It's been a great conference so far. It's just getting started. But my name, as Shelly said, is Aubree Greenspun. I work for NASDAQ on the options derivatives team based in Philadelphia. As you are aware, NASDAQ runs 3 options venues in addition to our equity markets. We have the PHLX, NASDAQ options market we call NOM, and our most recent launch of BX options. While running 3 exchanges certainly keeps us busy and on our toes from day to day, what it offers you as our participants is flexibility and functionality and diversity. Our PHLX model is the standard customer priority pro rata market model. NOM is our price time environment, and BX is a combination of both offering the customer pro rata market model as well as price time, and gives a unique flexibility for us to provide a pricing model that is best suited to the customer remove friendly business. Excuse me. While you've heard about functional enhancements and new product endeavors as well as speed measurements from our competitors, what I'd really like to focus on today is what's most important and forefront of your minds is protections. Shelly mentioned many, and ISE mentioned some as well. NASDAQ can't be successful without constantly asking what we can do for our customers. Right now, that's offer very robust protections, from order and quote protections to execution price protections to broader risk controls. NASDAQ on all 3 of our markets offers a wide range of these protections. All 3 of our markets offer what we call fat finger, protecting orders upon receipt and rejecting those that obviously are priced incorrectly for the market they're trying to access. All 3 of our markets offer drill-through protections that we call acceptable trade range. What that functionality does is pegs your order to a price and only allows it to walk in small increments from that price. So if you send in an aggressive limit or a market order, we're going to slow it down and not allow it to trade at increments that vary drastically from the original price. In addition, we'll limit the number of increments we'll walk that order up. So we won't walk you indefinitely starting trading you at $2 and walk you up to $20 or $40. All 3 of our markets offer the ATR functionality. In addition, we offer the activity-based kickouts for market makers that we call rapid fire. Currently, we only offer a percentage based over a period of time. Later this year, we'll be expanding that to incorporate a volume-based kickout as well. In addition to the percentage and volume-based, we'll expand that same functionality to be across all symbols. So if you hit a rapid-fire trigger in any symbol or a grouping of symbols, we will pull you out of all symbols, regardless of trade or not, from the markets. Lastly, we will be introducing a true kill switch. We will be expanding the scope of our current trade info GUI to give you a big red easy button to truly pull you out of the marketplace with one click. Through that GUI, you can do any combination of MPIDs accounts, and once you've activated that kill switch, we'll pull everything out of our market, orders and/or quotes, not allow you back in until you've called and verbally attested that any issues have been resolved. Lastly, PHLX is our market center with all of our functionality, which includes price improvement and complex. We have complex trade protections as well. We have the fat finger that I mentioned on before, but we also have what we call acceptable complex execution range. That is similar to ATR. It will protect your orders from egregious execution prices, and we base that off of the calculated CNBBO of the strategy. In addition to all the protections I've already outlined, we strive to offer you the best customer service possible. Recently, we combined both our equity and our options customer service desks. So while there's still 2 unique phone numbers that you can reach out to us, all of those desks are integrated. So if you have any issues, regardless of options or equities, that one person will be able to assist you and get you out of the marketplace or deal with any issue you're having immediately. In fact, that desk actually sits outside of my office now, as well as some colleagues of mine. So as soon as we hear increased chatter, we know immediately there's an issue and we can get right on it and help you in your time of need. Before I close, I'd like to touch on a few other enhancements we have in the works. We currently have a rule filing pending with the SEC to bolster the NOM opening process. What we're trying to do there is align that opening process with the robust protections we already offer on PHLX. PHLX opening process offers a price discovery opportunity while limiting executions to a tight range of what we call the valid width market. NOM does not have a traditional opening market maker quote with requirement. We don't intend to change that. However, with this functionality, we will look for a quality market with considering both the liquidity on the NOM market as well as liquidity out there represented in the NBBO. Look for a tight spread before we'll open that market. What this enhancement should do is allow NOM to open much more rapidly than it does today, but also with a price validation. Of our 3 markets, NOM has grown and continues to grow at the most rapid pace. We want to ensure our participants have the best experience possible on that venue. In addition to that NOM filing, we have a filing with the Commission to introduce a lead market maker or specialist on our BX model, BX market, in addition to a directed order program. Once approved, we expect that marketplace to grow its liquidity pool and to, in turn, increase its market share. It's our goal that you are successful running your business. We pride ourselves on making our markets work for you, from offering a market model that suits your business to offering functionality to protect you from the unexpected. In order to achieve that, customer input is key. So please visit our booth, pull any of us aside. We'd love to hear your feedback. With that, I'd like to introduce our last exchange speaker for the day, Bill Bryan from NYSE Options.
Thank you, Aubree. Let me first say thank you all for coming. It's a pleasure to be here as always. And we'll start with telling you how excited we are. We recently received SEC approval for our new price improvement auction known as Cube. And we believe Cube will bring a new level of competition to the electric auctions market. Cube will support single-leg auctions for paired orders, which consist of an initiating Cube order and a contra order. When initiated, the Cube order will send a request for responses message that will disclose the price, the side, and the side of the order. The accompanying contra can designate the contra order as a single stop price, auto match, or auto match limit. In any case, the contra order receives a 40% guarantee subject to certain price improvement and priority rules. All market maker orders and quotes received during the auction are marketable against the cube are eligible to participate. Responses received marked with a GTX time in force will automatically be canceled at the conclusion of the auction and can be submitted in pennies. And the auction will end at a random time between 500 and 750 milliseconds. NYSE Amex is relaunching binary options. You may remember them as fixed return options or FROs. They'll now be known as binary return derivatives or BIRDs. And based on what we heard from our customers the first time around, we've made some changes. And those changes include to the VWAP settlement calculation. And we've done that so that our new method ensures that either the finish high or the finish low BIRD will finish in the money at expiration. We have a new BIRD's obvious error rule establishing a maximum price for BIRDs of $1.02, and BIRDs will trade in pennies with dollar strikes and have up to 5 weekly expirations. BIRDs will be allocated to specialists and e-specialists separately from the underlying stock, and BIRDs will have a unique QSIP number. And we did that because the last time we did this, we had some problems with the margin calculations, and we think that the new QSIP will eliminate those problems. We have 30 symbols and 30 QSIPs ready, and Thomson Reuters is right now disseminating BIRD values. So we expect BIRDs to begin trading in September, and we think this represents a great opportunity for smaller investors to trade binary options on a listed exchange. NYSE was the first exchange group to implement a comprehensive global risk mitigation system. Starting in February, firms were able to set their own global risk mitigation thresholds on both ARCA and Amex. The minimum threshold is 25 symbol level triggers in a 100 millisecond period, and the maximum is 100 symbol level triggers in a 100 millisecond period. If it's not set by the firms, it remains at the default of 50 symbol level risk triggers in a 100 millisecond period. After exceeding risk tolerances, the firms must call our trade desk. The point of this human contact provides a level of protection against additional risk due to automatic re-entry into the market. In March, we released dedicated takedown connections for quotes via Market Maker Direct. Dedicated takedown servers will carry out options Market Maker Direct quote takedowns for symbol level and user level takedowns while minimizing latency from other activity going on in the market. This makes Market Maker quote takedowns as fast and reliable as possible. Testing in enhanced cert is mandatory for anyone planning to use dedicated quote takedowns. NYSE and Amex and ARCA are undergoing a market data redesign, which will include a migration from ARCA book to XDP. This is a non-backward design, and clients are urged to prepare for this transition. We have a webinar scheduled for Tuesday, May 6th at 4:15 p.m. Write that down again, May 6th, 4:15 p.m. It's an important webinar and will cover complete sets of functionality. Initial functionality will be available in the cert environment for testing in May. The new XDP client option spec has been published to www.nyxdata.com. And lastly, in keeping with our commitment to education, we partnered with OIC and hosted our second Thought Leadership event last year. These events bring pensions, endowments, and wealth managers together with other money managers and advisors who use options in their practice. Our next event is scheduled for June 12th. So stop by and visit us. We're at booths 6 and 7. Enjoy the rest of the conference. And now help me in welcoming Jeremy Johnson back to the stage. There you are, Jeremy.
So, and this event would not be possible without all of the exchanges working together. So thank you again, all of the exchanges, as well as all of our sponsors and exhibitors and participants. Thank you guys for doing that. So now all the technical updates are out of the way, all the commercials are finished. We're going to switch it up and do something a little bit different. I'm going to bring out our next group, introduce them, and then explain a little bit what we're doing. So please help me welcoming them on stage. I'd like to bring up Joe Corcoran, Head of Government Relations from the OCC. Ellen Green, VP SIFMA. Alan Grigoletto, come on up, Alan. Alan Grigoletto, VP OIC. Carolyn Mitchell, VP OCC. And Jim Toes, CEO and President STA. Okay, thank you. Thank you, guys. So you can be patient with me and them. I've asked them to do something that we've never done before. It's although it's set up like a panel, it looks like one. It's not going to be one. What we've got up here, we've got some great organizations, some groups that folks are involved in that have some updates to communicate to you. But I've asked them to get up here and just pretend like they're the 5 smart friends that they are, and get up here and have a conversation for half hour, a little bit more, and talk about things and converse with each other, ask each other questions, and hopefully we can get a lot of great content out of that. I'm going to kick it off for them and then let them run, and hopefully without any guidance, this is all going to come off, and you guys will get all the same content that it would have been with some sort of panel or something a little bit more organized. So yesterday, Mary Jo White was testifying before Congress. Some testimony. Jim, I know you put out an article on that. Can you talk to us, talk to your friends up there about what's important in that and what's going on?
Sure, that's great. Well, listen, thank you, and thank you for taking the shot on us to try this new initiative.
Absolutely. Have that.
And you didn't say like smartest people when you were talking about us. You told me it was going to be something like the world's deadliest catch, and I was going to be Sig, sitting around with a pitcher of beer talking to folks. So. Yesterday we were down in D.C. yesterday. It was Mary Jo White testified before the House Financial Services Committee. It was 3 hours of testimony regarding her, her ask for 2015 on her budget. It was a very long hearing, 3 hours, like I said, but it was a lot of repetition in the questioning. That's because a lot of the congressional members really had to get on the record asking a question that was was probably of interest to a particular constituent of theirs. So they probably could have done it in an hour if they didn't repeat all the questions. For the most part, I mean, just from a pure observation standpoint, I mean, she was very consistent in her responses. She was very direct. Her understanding of market structure is good, even for a market structure person, and it's very good when you think about that her background is more as a prosecutor for white-collar crimes, and is more about HFT and topics such as that. The article that we wrote about, though, is really just an observation, and it's something that I think, as we all kind of do self-reflection over the past 3 weeks, is that our perception of the SEC sometimes just kind of blurs from one commissioner to the next. And we don't realize that commissioners really do drive the agenda at the SEC, and that the SEC is different as you go from one commissioner to the next, based upon their skill set, based upon the various agendas on it. So, she's been in the seat now for a year. It does get a little frustrating when you're sitting there and she's being asked questions about events that happened in 2006 and 2008 and going even further back. And the article really is just about, listen, it's going to be different with her. We're not going to say it's not about whether she's going to be better or worse than her predecessor. It will be different. She's a year into it. Things already are different. And that it's in our best interest as individuals in the industry, and also as an industry overall, is to have a little bit more of an open mind with her now that she has got her staff put together and is getting on with business. So the article is titled Captain Obvious, because all we're really claiming, we're not making any bold predictions in the article that she's going to be better or worse or the same. She will be different. I know it's probably that's a bold prediction to make, but I think we should all be giving her benefit of the doubt for now until she proves otherwise. So listen, DC is a fun place to go. I recommend you all go down there. Try to find time to go down, meet your congressional member. Grassroots is always important. I know that Joe spends a lot of time down there, so I'm going to roll it over to Joe to talk about some of the work that OCC did on Congressman Camp's tax legislation. That obviously was a huge piece that was there were no books being written on that.
Yeah, thankfully at this point in time. I think Jim's referring to a book that came out after the '86 tax reform called Showdown at Gucci Gulch, which is an excellent book on tax reform if you're interested in the topic. But anyway, as you probably know, Chairman Camp released his proposal at the beginning of 2013, and it would mark all derivatives to market, including listed options. It would have some particularly bad consequences for listed options, and namely, it would trigger gains in underlying stock positions if you wrote call option or bought a protective put. So obviously, these are very severe consequences for the listed options markets. And we took the proposal, it was a draft proposal, we took it very seriously. We were very concerned about the impact that it would have on individual and other investors, as well as the impact it would have on options market liquidity and the underlying equity markets. Since the proposal came out in January of 2013, we've been very active on the Hill, and particularly the House Ways and Means Committee. Chairman Camp, obviously, is the chairman of the House Ways and Means Committee, and we've educated a lot of members on that committee about our concerns with the proposal. We've also spoken to folks in the Senate, although the proposal hadn't gotten a lot of traction in the Senate. Fast forward to February of this year, Chairman Camp released a comprehensive tax reform discussion draft. So for many years, he's been working on putting together a comprehensive tax reform bill. He ran into a lot of resistance among House Republicans about putting out the bill because his goal was always to get individual and corporate rates down to 25%. And in order to do that, you have to take away a lot of deductions. And I think as it got closer to the time for him to put out his draft comprehensive tax reform bill, a lot of Republican members got nervous because it was coming up on an election year. Anyway, Chairman Camp went ahead and put it out in February. This draft bill did include a mark-to-market proposal for derivatives, and it's basically unchanged from the original January 2013 proposal as it applies to listed options. There is a small exception in the proposal for certain covered call transactions, but it's very limited in nature. Obviously, we're going to keep working in DC. Chairman Camp, as you probably or may have heard, he announced that he is going to retire at the end of this Congress. He's term limited as the chairman of the House Ways and Means Committee, so he's going to step down. And so our focus at this point, I think right now it looks like Congressman Paul Ryan is the presumptive favorite to become the next chairman of the House Ways and Means Committee. So our focus at this point and down the road will be to, start talking to Congressman Ryan and his staff and educating them about our concerns with the proposal. As far as, let me turn it over to Ellen, because I know that SIFMA has been very active in 2013, the SIFMA Listed Options Committee. So if you could talk about that, that would be great.
Thanks, Joe. And certainly CAMP is a proposal that some of our groups worked on, and it's good to have an update from you on that. In 2013, SIFMA focused on several initiatives that were designed to harmonize several options rules across exchanges. We believe that this is something that can greatly benefit both market participants as well as the end investor. We identified two issues that we really believe required our focus: obvious and catastrophic errors, as well as pennies. While neither item was fully completed in 2013, SIFMA appreciates the exchange and SEC focus on these issues and recognizes the accomplishments that have been achieved to date. SIFMA acknowledges that the exchanges are for-profit businesses that look to differentiate their product offering in order to drive order flow to their venues. However, for non-competitive issues such as those that I just mentioned, SIFMA believes consistent rules benefit both the industry as well as the investor. One of SIFMA's board-level priorities for 2014 is investor trust and confidence in the markets, and harmonizing certain rule sets in options that benefits the customers is an action that our industry can engage in. 1 year ago, at SIFMA's OIC committee meeting, we asked the exchanges to focus on obvious and catastrophic errors. We were able to identify some of the deficiencies that existed with the various exchange sets, and I'm sure everyone here is well aware that each exchange does have a unique set of rules, and these can vary in different categories, from the amount of time to file, the means that you filed, and we really heard that if there was one way to do things across the exchanges, that really would benefit the broker-dealers. Our committee did a holistic review of the rules, and this was really driven after there were several exchange rulings that disadvantaged the retail investor, where the adjustment of the execution price resulted in one that exceeded the customer's limit price. As a result of several highly visible events in the second half of 2013, including the NASDAQ SIP outage, the SEC asked that the options exchanges work on several initiatives together to strengthen market resiliency. One of these was the harmonization of obvious and catastrophic errors, and SIFMA applauds that that the exchanges are working on this and that the SEC has asked them to do something since it is consistent with the commitment that we had previously made to this. There was much legwork to be done initially to get the rules up to speed, and SIFMA has been working with the exchanges, and we do look forward to seeing the rules when they're published in the Federal Registry and commenting on those. Another issue that SIFMA was engaged in 2013 was the penny debate, and we recommended that the exchanges create a uniform permanent program. While our committee did not have consensus on how many names should be in the program, the committee was in strong agreement that creating this permanent program would greatly benefit the industry and end investors. We're generally in agreement with what has been articulated by the exchanges to us and do look forward to seeing the rules when they're filed. We understand that there's been considerable resources devoted to this project. However, the rules have not yet been filed with the Commission. This requires that the exchanges continue to file extensions of the pilot program, and we see the current pilot is set to expire on June 30th and appreciate that the exchanges will file extensions as we approach that date. The SIFMA committee strongly encourages the exchanges to expedite the process as feasible so that the filing can be submitted to the Commission and we can go ahead and have a permanent program in pennies. One of the questions that I was hoping to address to Alan, certainly there's been a lot of talk about education. It's something that SIFMA is focused on. And I was hoping you could spend a few minutes talking about what OIC is doing to promote options education. And a question I'll also throw out is, do you think the high-frequency trading debate will erode retailer investor confidence in the markets? And if it does, what could the industry or OIC do to combat this, if anything?
Well, thank you, Ellen. I'll take the second part of that question first because it's the most controversial. And of course, any answer that I give you on high-frequency trading, I will irritate half the people in the room. So if you've read Michael Lewis's book, you obviously have an opinion on that, and I won't really express my opinion on high-frequency trading except to say that we do get asked the question about high-frequency trading when we're out speaking. Most recently, Joe Corcoran had OIC down to Washington. We gave I'll call it a plumbing report on the structure of the options marketplace. We had some questions about high-frequency trading in the options space, and as you're probably aware, the high-frequency trading in options is a small fraction of what is reported in the cash market. So we educated them on why that is and went over basically the different pricing models that exist amongst the varied exchanges and why options have a unique, because of their Greeks, you can't really optimize options in the same way you would with what is called high-frequency trading. And I'm not talking about high frequency in the sense of being faster than the other guy. I'm talking about, you know, the types of trading, proprietary trading models that are out there within the marketplace. So we do try to educate not only the people down in Washington about what high-frequency trading is in our particular marketplace. We get asked the question quite a bit when we're out there speaking to the retail audience because, unfortunately, perception becomes reality, right? Because if people perceive that the markets aren't fair
and equitable for all. What do they, the question in their mind is that they don't want to participate. So that is a concern, because everyone in the audience here derives their income from increasing volume. That's the common denominator that we all live by, right? We have to grow this business in order to make money on this business. And clearly, I think, we have a perception problem. As for the first part of your question, what's the latest in options education? We are everywhere. I don't know if you know, for those people in the audience who may be not familiar with the OIC program, we have a mission to educate. And that mission to educate is not just for retail, not just for wealth advisors or institution. We are across the globe. We're educating in Europe. We're educating in the Middle East. We've had tremendous success with our initiatives in China. For those of you who are not aware, China is going to launch 5 options exchanges. They are moving very, very rapidly. I think we learned just recently that they received CRC approval to launch their first options exchange. We also got some, I can't substantiate the news, but the belief is that they have changed their minds on market making on an option exchange. Initially, it was going to be an order-driven marketplace, and options in Shanghai is going to be the first exchange to employ market makers, which is, from a standpoint of everyone in the room, that is the right way to go. We're encouraged because China has linked now with Hong Kong and also with Taipei. And of course, the holy grail would be for down the road for China to be openly trading with the US and vice versa. So I think we're playing a role in helping to educate and help to improve the business climate out there. I'll turn my next question over to my colleague, Geralyn Mitchell. So why don't you tell us what's happening at OCC? Because you've had a new milestone in just a recent period. What is it and what does it mean?
Okay, well, for those of you who've been coming to this conference for the last few years, you've heard me talking about OCC is working on a clearing service for over-the-counter options. And so I'm happy to be sitting here and saying that we have launched that clearing service. We launched it last Friday, so that provides central counterparty services for OTC index options, and we're starting with index options on the S&P 500. We launched with 3 initial day 1 participants, and we expect to have 3 more signed up by the end of this week. There are certain parameters of trades that we'll accept to make sure they're truly OTC in nature and not retail in nature. And I should also mention that this is a dealer-to-dealer phase that we launched. So the next phase of this will be later this summer when we launch dealer-to-client trades. So we're happy to, there's a long road to get there, but we're very happy that the service is now up and running.
And you're ahead of the curve, right? Because there's no real mandate to do this as yet. I mean, certainly in the fixed income space, right, that's where the mandate lies, but not so much with these kinds of products.
Yeah, that's exactly right. I mean, everything that you hear about OTC in the United States is really around rates and credit, and there is not any requirement to clear OTC trades on these equity derivative options. So we did it for a couple of reasons. One, we think that it provides some benefits to our clearing members who can now hold OTC positions and listed positions in the same account for margin efficiencies. But we also believe that clearing provides a safety and soundness that's just the right thing to do. So we worked with a group of 7 day 1 participants and then had a larger group of clearing members and other dealers who are big in the OTC space and determined where we were going to start with index options. And they've been very supportive, and we're happy to have this service available now.
I'm going to give you a second part to my question.
No one, he doesn't know that you can only ask like 2 questions.
No, I'd like you to tell the audience about the progress we're making on the ODD.
Okay. So you know what, I'm chairing a committee, an ODD committee, and it's a very exciting committee to be chairing. For those of you who don't know, that stands for the Options Disclosure document, and it's 183 pages long.
And growing.
And growing. It grows with every new product, and it's a pretty tough document to get through. So there, we have this committee, and actually there's many people on the committee sitting in this room. And look at all of you. You all can jump in and participate. But it's exchanges as well as broker-dealers and also OCC. And what we're trying to do is take a step back and look at this document. I mean, it was created over 40 years ago. My colleague Rich Geralyn informed me that the ODD was put together before we traded puts. So it gives you an idea of how old this document is. And it has grown over the years, and there's addendums that sit in the back, and it's a pretty hard thing to manage. So this committee is really looking at, how would we reform it using current technologies, trying to shorten it, trying to make it more understandable to a retail investor. Right now it's written kind of by a lawyer for a lawyer. And we feel like we're making progress. Our next step is to go and meet with the staff at the SEC and get an idea from them what flexibility we have for reform. How far can we move? Can we use more internet technologies? Can we put this online and do more with links? Today it's very costly for all of the firms to be sending out the ODDs, and there's a lot of requirements of how often they do have to distribute it. So our next step, Alan and I went and talked to FINRA about this already to get their views on it, and they really support what we're doing and agree that the document probably isn't serving the purpose that we all intend for it to serve.
And ideally, we'd like it to be somewhere in the nature of about 35 to 40 pages. We think that would be the right amount to at least, streamline that document.
Yeah, I mean, we have opinions across the board. We have some people on the committee who think it should be 2 pages long, and some who don't think we should change it at all, and then the majority are somewhere in the middle. So we did do a survey. We put it out online, and a lot of you sitting here, your firms, helped us disseminate this, but we had just about 1,000 responses, and it was interesting to see that the majority of investors actually do try to read this document, but I want to say over 60% of them state that they can't get through it because it's too long, it's too complicated, they can't find the information they need, they don't understand it, they have too many questions, so they just kind of put it to the side. So we're excited to find out what parameters we might have for reform and then move forward in trying to implement them.
So Jim, I know you, like I do, spend a lot of time on the Hill, and I wanted to get your sense about how Hill staff and members of Congress, how much they understand market structure or don't.
No, it's a good question. I mean, because we get asked that a lot, and sometimes when you walk into someone's office, you never know whether you're gonna, you always start down low and, and then kind of work your way up, and you have to kind of make that decision pretty quickly if they, based upon facial expressions usually, if they understand the topics or not. As far as a general understanding down there on the hillside, I would say it's probably better than most people in this room think. It's just where it is. Yes, at the congressional level, we have 65 congressmen that have oversight of our industry. Do all 65 of them understand our industry? Absolutely not. There's probably around 20 to 25 that have an interest, that have some type of private sector experience that they can equate that experience to what we do, and there's some dialogues that can go back and forth on it. The part that and those people obviously are important because they are driving the mindset of the other 35 or 40 people on the committee. The part that I think that where we get encouraged on is really at the staff level. Each congressman has a staff member. These tend to be, the staff members tend to be, in that 27 to 32 year old category, intelligent kids, intelligent people that go, if their congressional member doesn't win a re-election, they go and they stay within the committee itself. So there's a good mind trust at that area. But then when you go one layer even deeper, and that is at the committee level. So each congressman, if I sit on the committee, I have a staff member who works for me, but then there is a committee that is a group that services the whole committee. And that's really where the brain trust is. That's with the Kevin Edgars of the world, the Kevin Edgars, the Mike Aherns, and then on the Senate banking side, for example, I mean, our commissioner today, Mike Pivovar, was a former Senate banking economist. So, you know, as far as knowledge, because we do get asked that question a lot. They don't know anything about our business, to which I always say, well, how does a bill become a law? No one really knows that answer in our business, right? You know, especially when the lobbyist comes in at the last minute and changes it up a little bit. But it's a lot better than I thought. I'd like to go back to on the education part, because I think the education part that you kind of talked about was really, you know, in the aftermath of the book, The Flash Boys coming out. I mean, there was a tremendous amount of information and sound bites of coming out there, and I do think that the education part that you play, that we all play, and is very important. Not just, and it gets lost because it doesn't come into the media. A lot of the market structure analysts that are out there now at large firms that are dealing with a lot of the large accounts really put out some unbelievable material in that week and 2 weeks after it. That was very, I think really put a lot of people at ease and doesn't get the attention that it probably deserves. So what do you think about HFT? What's your official stance?
One of the things that SIFMA is doing this year is we do have a board level committee that is focused on equity market structure. You know, we've determined on the options side that we'll weigh in on certain issues if it's appropriate and we feel it's going to impact the markets. However, we're really trying to call it an equity market structure review as opposed to HFT, because we believe that high frequency trading is one facet of the markets that should perhaps be evaluated in addition to things like the SIP feed, order types, and other issues that are impacting the industry. So I think that this is something that you will hear SIFMA talk a bit more about as the year progresses, and we're able to, you know, drive to some resolutions and some points. SIFMA did issue a white paper on the topic several years ago that's on our sifma.org website, which has some good information on it, and is something that folks can take a look at if they're interested to see what some of our initial thoughts are on that topic. But just continuing, some of the topics that the Options Committee continues to focus on this year, we obviously are continued to focus on seeing through the uniform rules for both obvious and catastrophic errors, as well as a penny program. And I think the events that we saw yesterday, unfortunately, reminded us how critically important it is that these rules do get filed with the Commission. It's important, I think, from a firm perspective, that these situations are handled very quickly because firms really need to manage their risk. And if they have hedges on, the longer that these situations last for, I think the more difficult it does become for some of the market participants. We've also identified two new issues that we'll be tackling this year. The first issue is the strikes listing procedure. We recently began our review of this procedure as a couple of folks brought to the committee just some particular issues about it, and there seems to be, from some of our committee members, some confusion and frustration about how the process works. And I think as we look at it, we recommend that this is an area where there could be a uniform rule set created, because we think it would really benefit the industry. We also think that's applicable to the corporate action events, because I know with the recent Google stock split, that was another issue that caused some confusion in the industry. From that issue, we think that it would be beneficial to see OCC, the exchanges, as well as the Commission work collectively on this. And you know, at this time, I would say we had the exchanges into our committee meeting this morning, and you know, SIFMA really would welcome one of the exchanges to step forward and take a leadership role in this. Another issue that SIFMA has become active in recently is the recent OCC fee increase, which took place on April 1st. The fee increase was driven by the regulators. They're carefully examining the systemically important financial market utilities, or SIFMUs, and the regulators want to ensure that these utilities are well capitalized for stress situations. SIFMA submitted a comment letter in April, which we understand OCC is in the process of responding to. In our comment letter, SIFMA requested that OCC provide more transparency into their capital requirements and that they clearly define an exit strategy from the fee increase. While OCC states in their filing that such impacts should not extend beyond 2014 based on current projections, SIFMA does believe that additional disclosures should be made by OCC so that their members and the industry have more transparency into the required metrics, which would allow them to achieve these surplus capital goals and revert back to their prior fee schedule.
You're looking at me,
I didn't mean to.
I won't address that because there's someone who's quite a few pay grades above me who will address those issues later on in the week.
But yeah, I guess one point or one technical point is it's not technically a fee increase.
Correct.
It's an elimination of an elimination of a discount that occurred.
Plus, I think maybe the broader topic here is that we've always heard about we've read about Dodd-Frank, we've read about the Volcker Rule, we've read about the Treasury Department having more of a interested look into our market structure, and that at some point this regulation was going to lead to increased costs. That day is now coming upon us. All right, and it's not whether it's OCC today, it could be asset managers tomorrow, which was a huge focus of, if we heard one more question at this hearing on the Office of Financial Research report on how asset managers pose a systemic risk to the overall health of the financial industry, I think around 20 congressmen asked the same question. You want to get up and say, you get the guy to your right just asked the same question, weren't you paying attention? It's starting to kick in now. All these things that we've heard about, Dodd-Frank, increased cost of regulation, these things, the DC and Wall Street, we move in two different time warps. We think that, well, yeah, we talked about that on Monday, and I thought it was over with. No, in DC, yesterday is 3 years ago, and it's unfortunate, but a lot of these costs are going to be starting to roll out soon.
I think we're out of time. At least that's what the clock says. Do we have time for questions, Jeremy? Okay.
Okay.
All right.
Thank you.
Thank you.
I just got to thank you guys very much.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.